In late 2021, a DeFi protocol was advertising an annual yield of over 7,000%. Not a typo, 7,000%. People were staking their life savings into it, tattooing its logo, chanting a three-character meme like a religion. Within a few months, it had lost over 90% of its value. Today, we're breaking down what actually separates a real sustainable DeFi yield from one that's mathematically guaranteed to collapse, using the protocols that become the poster child for getting it wrong. So, Olympus DAO, launched in 2021, built around a token called OM and a pseudonymous founder known only as Zeus. Its pitch was that OM would become a decentralized reserve currency backed by a treasury of other crypto assets rather than pegged to a dollar like a stablecoin. The mechanism works two ways. Users could bond, trading assets like LP tokens directly to the protocol at a discount in exchange for OM, or they could stake their OM to receive as OM, or a staked OM, a rebasing token. Rebasing meant that the amount of staked OM sitting in your wallet would automatically grow based on whatever APY the protocol's community had set. And that APY wasn't modest at all. It regularly ran at thousands of percent. So if you held one as stake OM and the APY set at 5,000%, you'd have roughly 50 staked OM in your wallet a year later, just from staking and doing nothing else. This spawned crypto Twitter's infamous 3.3 meme, shorthand for a game theory idea that the optimal move for every OM holders was simply to stake and never sell, so that everyone will benefit together. It spread fast. Olympus went from under 15,000 vault holders in mid-September of 2021 to 75,000 by November 23, the day its market cap peaked at $4.36 billion, with OM trading around $1.415 a token. Respected voices in the DeFi space gave the founder airtime and legitimacy, and dozens of copycat OM forks launched across multiple chains, each promising even more absurd APYs. Then, on January 17, 2022, a large holder known as Shota_SK sold about $11 million worth of OM, publicly explaining he was de-risking for my familia, triggering roughly 25% slippage and a $5 million in cascading liquidations. That single sell kicked off a rout. OM fell over 90% from its all-time high within weeks, and Ponzi scheme stopped being a fringe accusation and became the default description most of the industry settled on. Here's the mechanical problem stripped of the memes, obviously. When a protocol pays you thousands of percent in APY, it's not paying you thousands of percent more dollars. It's paying you thousands of more percents of its own token. That distinction is the key in this entire story. If the token supply is inflating by 5,000% or 7,000% a year to fund those staking rewards, then for your actual dollar-denominated wealth to stay flat, demand for that token needs to grow at roughly the same explosive rate, just to absorb all the new supply without the price collapsing. And that simply is not a sustainable growth rate for anything ever. Real-world demand, new users, new capital, new believers simply cannot compound at $5,000 a year indefinitely. So the entire system depends on a constant accelerating stream of new buyers, specifically to offset the dilution being handed to existing stakers. The moment that inflow of new demand slows down even slightly, the math flips and supply is still growing exponentially, but demand isn't keeping pace, and the price has nowhere to go but down. This is functionally identical to how hyperinflation destroys the value of a national currency. Printing more units doesn't create more real wealth. It just divides the same underlying value into more pieces. A rebasing token promising thousands of percent of APY is running that exact playbook on itself by design, in plain sight, and calling it yield. The Olympus treasury did hold real assets, which gives OM a theoretical floor, or the backing per token that bulls pointed to. But once a market price traded at 5 or 6 times premium above that actual backing, as it did through most of 2021, the tokens wasn't being valued on fundamentals anymore. It was actually being valued on the expectation that the next wave of buyers would keep showing up. That's the exact definition of a Ponzi dynamics, whether or not anyone involved intended it in that way. Real yield flips the entire structure. Instead of printing more of the protocol's own tokens to pay stakers, the protocol takes actual revenue it earns from real usage, trading fees, borrowing interest, swap fees, etc., and distributes that revenue to token holders in a stable external asset, usually ETH, sometimes a major stablecoins, but critically not more of the inflating tokens itself. A few real examples that define this shift actually started around 2022. GMX, a decentralized perpetual exchanges, distributed 30% of trading fees it actually collects to GMX stakers, paid out in ETH or AVAX depending on the chain, with the remaining 70% going to liquidity providers. Gains Network runs a similar model through its G-Trade platform, sharing a real trading fee revenue with GNS stakers. Synthetics, one of the oldest DeFi protocols, at various points also distributed effectively all of its fee revenue back to SNX stakers. Curve does similar through its V-Curve flockers, who receive a share of trading fees in the pool's own underlying assets, not newly minting CRV tokens. So here's a practical checklist you can actually apply before putting money into any high-yield DeFi opportunity. First is the yield paid in the protocol's own token or in an external assets. If your reward is more of the same token that's inflating to pay you, ask what happens to your real return once you sell it. Second, does the protocol have verifiable revenue? Dashboards like Token Terminal or DeFi Llama shows real trading volume and fees for most major protocols. If a project claims massive yield, but you can't find real usage data behind it, that's a red flag, guys, not a coincidence. 3. What's the price to earnings ratio? Divide the protocol's market cap by its annualized revenue, the same way you'd value a stock. A PE in the teens to 20s is at least in a reasonable range for a real business. A PE in hundreds or an APY so high the implied PE would be negative or nonsensical tells you that the price isn't connected to the actual cash flow underneath. 4. Would the yield actually survive if new deposit stops tomorrow? Real yield, sourced from actual trading activity, keeps flowing regardless of whether new capital shows up. Ponzi structured yield requires a consistently growing base of new entrants just to keep paying the existing ones. The moment growth stalls, the whole thing is mathematically exposed. So, is yield farming still worth it? Worth correcting the premise here before answering it directly. Transaction fees on Ethereum hasn't been ballooning. They also actually collapsed to some of the lowest levels in the network's history. The March 2024 Dencun upgrade introduced the blob data specifically for Layer 2 networks, cutting L2 transaction costs by roughly 80 to 90% almost overnight. Follow-up upgrades since then, the Pectra in mid-2026 and Fusaka at the end of 2025, pushed things even further. As of 2026, Ethereum mainnet's gas typically sits below 1 GUI, meaning a simple transfer costs somewhere around 10 to 20 cents. And transactions on major L2s like Arbitrum, Base, and Optimism now often cost a fraction of a cent to a few cents, even for a multi-step yield farming transactions. If you step away from DeFi for a few years ago because of gas fees made small positions pointless, that specific problem has generally been solved in the 2026 year. So the real question isn't can fees eat my yield anymore, it's whether the actual yield on offer is worth the risk you're actually taking on to earn it. And here's the honest trade-off. With fees now negligible, smaller position sizes are viable again, which is a real win for retail users who got priced out during the 2021 era gas wars. But the flip side is that the eye-popping numbers from 2021, the thousands of percents of APYs, was never real yield to begin with, as Section 1 and 2 just covered. Genuine revenue-backed yield today from established protocols tends to look far more modest, often somewhere in the mid-single digits to low double digits, depending on the protocol and market conditions, not the fantastical numbers that define the DeFi summer era. So, is it worth it for now? For a real yield protocol with very valuable revenue, low transaction costs now makes even a modest position size practical in a way they simply weren't a few years ago. Cheap fees are a genuine tailwind, but no fee reduction changes the underlying math from section 1 and 2. So if the yield you're chasing is still denominated in a rapidly inflating token with no real revenue behind it, cheap gas just means it's now cheaper to get into a bad trade faster, not the trade suddenly gets any better. So overall, if you are thinking of trying to get into DeFi and do yield farming, obviously it's not financial advice, but I recommend you to go to a real yield protocol. So if they give out real yield, say in ETH or on any other stable coins, that is a key green flag that probably you want to enter the protocol itself if you actually want to do yield farming. But do note that the APY is strictly very low compared to the thousands of percent such as the Olympus DAO cases, which definitely is not a good thing for you as a yield farmer. Anyways guys, if you like this video, please click like and subscribe to the channel. If you want also to check out my other videos, both here. I'll see you guys next time. Stay safe guys, stay curious, and I'll see you guys next time.